Back to our PowerPoint slides, let's take a look at the pros and cons of LBO investment. First, the biggest advantage is that M&A is possible with relatively a very small investment amount. As I said earlier, I only need $2 million to acquire a company worth $10 million, for example. So the fact that I can invest in companies that I would not normally be able to acquire is a huge advantage of LBO. And second, from the investor's perspective, there is a strong incentive to improve management efficiency and increase the enterprise value. In particular, since they borrowed a large amount of money, now they have to repay the principal and the interest expenses, which creates really a big, huge incentive. Next, the interests of the owner and the management are now aligned. So private equity funds usually appoint management that fits well with their interests. And lastly, it is very important that there is a tax shield effect on high debt. So we can save tax due to high leverage. So simply put, tax shield is possible since interest expenses are always, well, I wouldn't say always, but in most cases, tax saving. So you pay less tax as much as the amount of debt. This has the effect of greatly reducing financial costs, and these four, I think, are the biggest advantages of a leveraged buyout model. However, as all types of investments, there are also disadvantages. The first, while LBO investment is a good investment when all things go well, because it involves a lot of risk, when it goes wrong, there's a very, very high risk, especially when the company value, the enterprise value is falling. And second, the cost of borrowing is a huge burden, especially when the company's EBITDA is not very good, or cash flow is not very good. In other words, the schedule for repaying the borrowed money is fixed, so the interest cost is also fixed, and this could be very burdensome for many companies. The third is the uncertainty related to the exit. So for example, if you're an investor who invested 5 years before the outbreak of COVID-19, and let's say that you plan to exit during 2020 or 2021, it would have been very difficult. The market conditions and the stock market may not be good when we try to exit our investment. And then if it's a very early startup, the LBO model may not be appropriate even if the growth prospects are good. This is because collateral must be provided to the company, and early stage companies lack track records or credit. Therefore, it is very difficult to apply a leveraged buyout model, and there is some business risks. In other words, startups, they might be too risky to perform an LBO. And lastly, because these are projects that involve a large, huge loan, and there are so many players involved in this rule. For example, maybe banks, institutions that lend you money, they often make demands to the company shareholders, saying, we're going to lend you this money, but you must obey these rules. You must not have additional debt. You must have an interest coverage ratio of some level. You must have a debt coverage ratio of some level. Those kind of covenants may be applied. Same goes for the government as well. They do make similar demands, and as I told, since many stakeholders are involved in this case, and especially when it goes wrong, there are so many regulations, so many oversights by the government. But however, LBO is basically carried out because usually we think that there are more advantages compared to the disadvantages. Now, we did see the pros and cons of LBO investments, but remember that LBOs can also go wrong. We're always looking at the bright side, but for example, there was a very big energy project called Energy Future Holdings, which we can see KKR, TPG, Goldman Sachs, one of the most famous private equities and investment banks in this field. They participated in this and they did make a big bet in 2007. However, as some of you might know, there was a shale gas revolution in the US in the late 2000s, and energy prices crashed. And these players ended up filing for bankruptcy in 2014. And this is one of the biggest losses in history of LBOs. And this shows that LBOs don't always make a very positive outcome. Next, we're going to see about the key players of leveraged buyout deals. So who ultimately carries out the leveraged buyout? First, we have the acquirers, in other words, the sponsors. There are GPs and LPs, so general partners and limited partners that I mentioned earlier. GPs are usually private equity funds or venture capitals that are the main players in this deal. And these private equity firms can be global firms, but there are some regional firms that specializes in a certain region, or there can be some firms specializing in certain industry. For example, healthcare, aviation, semiconductors, and so on. And limited partners, when we say limited partners, usually they are pension funds, insurance companies, banks, and private foundations. They do act as LPs. They manage large sums of money and entrust some of that to the general partners. So therefore, we can also consider them as one of the equity investors. And of course, we do have the senior bond investors on the bottom. We include banks, insurance companies, again, pension funds, some securities companies. They provide senior debt, but in most cases, I would like to say there are banks. Usually first-tier financial institutions. And if there is a shortage of funding from the senior investors, now we move to the subordinated or the junior investors who prefers higher risk and higher returns. For example, hedge funds, mezzanine funds, securities companies, they invest in subordinated bonds or bridge loans and loans like convertible bonds, preferred stocks, and so on. These players are very usually small companies, so it is somewhat difficult to name a well-known company, but as you can see, our examples do have one of the most famous companies as examples, but there can be very small companies that we never heard of, even financial experts. And for an M&A to be done, there are other participants as well, like investment banks, law firms, consulting firms, accounting firms. They participate in the deal and they are very deeply involved, especially in the acquisition process and the exit process. And of course, there is the target companies. So there are many players involved in a leverage buyout, but on a modeling perspective, what are we going to learn? We're going to learn how to model from the private equity's perspective, trying to figure out the returns, the potential returns that the private equities could achieve if they collaborate with all these players and if they acquire some kind of target company.